Warm welcome to all of you. This is K Asnani from Smart VERC Bhopal. And to start with, here you can see on the screen is the BSE Sensex returns distribution since the start of the BSE Sensex, that is 1st of April 1979. Let me tell you the data which I have plotted on this chart. So the base, that is the x-axis, shows the returns of the Sensex on year-on-year basis. That is on calendar year-wise basis. So plus 10% is the first entry, which shows that the years in which the Sensex has given a return of from 0% to 10%. So it is like this, as you can see, for 20%, 30%, 40%, and the numbers on this, each bar represents the years. And then on the top, you can see is the number of years. So it is very intuitive, I hope. And this is the compound return for a period of 44 years. That is the start. That is 1st of April 1979 to till date. That is why 2023 is also appearing here with a loss of about 5% since 1st of January. So it is appearing in minus 10% bracket. More about this later. Let's begin today's presentation. So let me tell you one more thing. This is a dividing line. This is the 0% returns, and these are the years. On the right of this line, right line is the number of years for which the Sensex has gained, and on the left is the losses. As you can see, there is a lot of asymmetry. Not many years companies have Sensex has made gains compared to the losses. So, as most of you are aware, we are conducting such webinars as well as insightful articles. Those who are interested and those who have not registered, with us, that means those who have received this information through their friends or through a group or through a forward, and send us a WhatsApp with their name and city. And our WhatsApp number is this, also appearing on my left side. Maybe on your screen, it might be on the right side. So our WhatsApp number is 9755920780. So this is our webinar number 141. Thank you for your great support. Starting with the poll, and it is going to be very, very interesting. Since the start, how many times BSE Sensex gained by more than 80% in a calendar year? Since start, and I'm asking for more than 80% returns in a calendar year. So option A is 0, means it has never happened that Sensex has gained by 80%. Option B is 1, option C is 3, option D is 7 times. So here is the poll. Soon it will appear on your screen. I hope you are able to see, and you have to click your option. Yes, I would like that all of you should participate. It's going to be very, very interesting, and don't bother about the privacy of your data. We are not going to share with anyone. It is going to remain with us only. How many times BSE Sensex has gained by more than 80% in a calendar year? So 65% participants have participated. 5 more seconds. I request all of you to participate, please. So here is the result on your screen. 7% say A, this is a wrong answer. 53% say B, this is also a wrong answer. And 23% say it is C, and this is the right answer. And 17% say the D is a wrong answer. So C is the wrong answer, is the right answer. 3 times it has happened, and those who have observed very minutely during the first screen might have seen this. We are going to share again what has and what are the years wherein the Sensex gained more than 80% in a calendar year. So these are the years 1985, 1991, and 2009. 1985, I was not an investor, and probably Mr. Kishore Kurswani was investing in this, and Mr. Kishore Kurswani is a marketing head. And that year, Sensex gained about 94%. In 1991, yes, I was very much here. I have seen how the stocks, and this prior to the what is popularly known as Harshad Mehta's time, and because the revolutionary budget also presented during this time. And then in 2009, yes, because after the great fall of 2008, the Sensex gained 81% in 2009. Here also, I was a participant. So probably estimated time is about 40, rather I should say 40 to 50 minutes. These are the webinar contents. First will be the learnings and where are we today, then a winning strategy, and then followed by question and answer session. So first the learnings. This is the BSE Sensex with a start on 1st of April 1979 as a base of 100, and these are the index values. As you can see throughout till date, means the latest last Friday 2023 Sensex was 57,520. Now by a very simple data, you can see Sensex has multiplied by 575 times since. That means in 44 years, Sensex has multiplied 575 times. 575 times. This is a phenomenal. This is huge by any yardstick. So, doing various combination combinations and using various formulas, I have calculated in the very up to the recent data that year-wise positive returns probability since the start. So if you, what does it mean? 1 year is 75%. So over during this period of 44 years, had anyone invested on 1st of January, then there is a 75% probability that you made a profit at the end of the year. That is on 31st December. 75% in any of the year had you invested. Since the start of the index, there is a 75% probability. Similarly, for any 2 consecutive years, had you invested, then there was a 70% probability. For 3 years, 90%, 4 years, 93%, and similarly for 6 years, there was a 100% probability. Yes, for any of the 6 consecutive years, had you invested in Sensex since the start, you should not have lost as far as the Sensex says. Now, coming back again to this, a very, very informative and insightful chart, and there are many, many learnings from here, and let's begin. So on the right side of this line are the gainers, means the years in which the Sensex has gained calendar-wise. On the left is the loss. First and foremost thing what we observe is there are many more years in which the Sensex has gained, and there are very less years in which the Sensex has lost. And then to start with, during 1986, there was a 10% fall. The very next year, there was 87%. There was 20% fall. Now, let me tell you what it means. 20% loss is a huge, as retail investors are concerned, because retail investors are mostly investing in mid and small caps, and when the Sensex falls, it is predominantly a large cap index. When the Sensex falls by 20%, I am very sure retail investor portfolio for most of the people, for most of the investors, it falls not less than 30% or 40%. So 20%, even 20% fall is a big one. So in 1986, it fell by 10%, another 20% by 1987, but then followed by 60% gains in 1988. So almost all the losses have been recovered in a single year. Going ahead, in 1998, there was 20% fall. I should not say 20% because it is between 10 to 20%. So it can be about 15% or 16% also. But this is only for the insights we are getting. We are not into the exact percentage. Here, the purpose is to see that whenever the index falls, what happens the next year or next to next year. So in 1998, index fell by about 20%. In 1999, in the next year, index was up by 70%. Huge. Now, another interesting data. In the year 2000, I'm very sure many of you must have been a witness to this great crash, and also known by .com crash. In the year 2000, market fell by 20%. Next year, again by 20%. And then what happened? In 2002, market was up by 10%, and in 2003, it was up by 80%. Huge upside. So not only this single year has wiped out the losses which the investors made here, including this one, and now we are almost at same level. Then comes the 2008, market was down by 60%. Then 2009, market was up by 90%. And then not only here the story stopped, but again in 2010, market was up by 20%. So this is 2008. Again, you all know what happened here. Subprime crisis in the US, and which spread like anything around the world. Similarly, story goes on. In 2011, 30% down. 2012, 30% up. Again, next year up. Again, 2014 up. For 3 consecutive years, market was up 10%, 10%, 30%. Like. So, whatever we have seen from this data is that one thing is very clear: market is unpredictable. Anything can happen. But one thing is also there: if the market falls by more than 20%, then in the subsequent 1 or 2 years at the most, it bounces back. And in many cases, we have seen that it gains much more than the losses. And the beauty is the compound returns are 15.78%. Yes, that is the reason why. That is the reason why Sensex has multiplied 275 times. Start on 1st of April 1979. Average returns, as I'm sure you all know the difference between average and CAGR. CAGR is the most appropriate one to consider, but here our intention is something different. I will show you why I am showing you the average returns. Average returns are 19.63%, and the median is 16%. Median means the extreme loss and the extreme profit and the middle reading. Why I am showing you all these things? Because why median and average, those things? Because I am trying to correlate the formation of this chart with normal distribution curve. Those who are from statistics or from engineering side, they know very well what is normal distribution curve. This is a bell-shaped curve, and at the x-axis, this is sigma, this is standard deviation. So 95.44% of the readings are between plus minus 2 sigma. And the similar thing is visible in our chart. Not only in our chart, but also in chart of USA. Yes, this is a data. Yes, of course, this I have taken from WhatsApp. And this is data of S&P 500 for the last 100 years. Yes. And here the S&P 500 grew at the rate of 10.36%. But you see, chart is almost resembles with our Sensex chart. Here also the middle line is here. So more of the positive years compared to the negative years. So if I try to draw a kind of a 2 sigma, that is standard deviation, then you will find that, because I have omitted this is not taken into consideration because this is a kind of an outlier. Yes, there are outliers, And even these two readings are outliers. This happens very, very remotely. I can say very less number of times it happens that the market falls by 60%. In fact, it is only the 1 year which the market fell by 50 to 60%, 2008. And as you can see, most of the readings are between these two, a kind of a hut or a kind of a bell formation. Now, this was the mean, as I already showed you, and this is the zero line. The beauty is center line lies here, which is to the right, that is on the gaining side. Now, if you see from the center line point of view, there are so many positive data and so less negative returns by Sensex. So this was all about the learnings from the Sensex, what has happened in the past, so that we get a confidence that what one can expect. Of course, this is only a probability. This is not a firm data. Firm data means this is not a 100% guarantee that it will follow this, but under the normal distribution curve, this is the fact. So before proceeding further, our next was where we are. This is going to be very interesting because as a country-wise, which country is at what stage of the debt equity cycle, inflation, and other parameters we are going to discuss. But before that, we are going to take a small 2 minutes of introduction to from Smart VRC. What we do is help investors create wealth from stocks smartly. This can be done in a very different ways, and we are doing it. And to give you a glimpse, in a sense, what we have achieved, a major achievement. There is a blue color. This is chart of smart billionaire picks. There is a collection of high performing stocks. I should not say high performing, but potentially high performing stocks. And we make changes only on Wednesday if required. Otherwise, there is no change. And the red line we are saying is the corresponding BSE Sensex. And this was started with 1 lakh rupees on 30th of May 2001. And today its value is about 1.3 crore. That gives compound returns of about 25.6%. That is phenomenal. And it tells everything, whatever you are looking for in an advisor. Truly qualified advisor in terms of qualification, in terms of experience, in terms of success, yes. And we have got about 17, 18 stocks all the time. We are not bothered from one Wednesday to another Wednesday because we can't do anything. We have done wonderfully well. That also shows not only the portfolio management skills, but also the stocks, how we have picked, and of course, a lot of patience. So these are the products, research publications from Smart VRC. One is Smart Gains, another is Smart Multibagger, another is Smart SIP. So these are the start dates. Product end date, all are perpetual. There is no end date. Compound returns in Smart Gains is 25 to 30%. In Multibagger, it is 30 to 40%. Smart SIP, it is 20%. Risk is medium, low to medium, and low. Yes, you may be wondering that how can a risk be low to medium in Smart Multibagger and medium in Smart Gains? Of course, because in Smart Gains, the holding period is up to 2 years, while in Smart Multibagger, it is beyond 2 years. And sell advice, yes, exit advice we do provide, because ultimately what matters is when you exit. Allocation advice we also provide. So that gives you an idea how much you should invest in a particular stock. In all the 3 cases, we do provide research advice. And philosophy is same, bottoms up. I can say that up to 85 to 90% of our focus is on the company, and the rest is on the sector and the economy. And I can say that on the economy, it is almost zero. Yes, We are not bothered about where the economy is heading, but we are bothered about what my company is doing. I have confidence on the company. Market cap, advice time, all during market hours only. We publish the reports all during market hours. And advice frequency here, it is every Wednesday. Here it is about 12 to 15 stocks are published in a year. And then here on the 5th of every month. Access to past advice, yes, you get. Once you subscribe, once you make the payment, automatically you get an access to all our advice. Subscription price is, excluding GST, is 6,000 rupees for 1 year. It is 8,500 and 4,000 rupees. Probably next month we are going to revise our subscription rates. So we use this medium to help investors create wealth through website, mobile app, webinars, like the present one you are watching, seminars, workshops, social media, and television. If you want to watch our previous webinars, then you are welcome. You go to our website, smartvrc.com, and on Smart Academy, there is a Smart Insights here, and select a category, or you can scroll down, look for the date. So we have as we have discussed, the smart products. Then we have Smart Insights Pro. These are divided into 4 categories, and these are small videos, each for about 15 to 20 minutes of length. And also, I'm an author of the book, Way to Billionaire. Book is available, and you can check on our website. Book is available in English as well as no technical jargons used. Also, we have got financial freedoms and more. You can watch. You can surf our website, smartverc.com. So these are the key differentiators. With a cumulative experience of 73 to 74 years, ability to find the worth of the stock. This is the most demanding thing we have. And so this was all about Smart VRC. So here we were, where we are. Government debt to GDP ratio. Let's see what the countries are doing for the last 10 years. And this all data has been sourced from tradingeconomics.com, right? And tradingeconomics.com has used the various countries, various departments, government departments. Like in this case, it is the Ministry of Finance from Japan. Government debt to GDP, you can see it was hovering around 230, 235. Then post-COVID, it jumped to 59, 262, and up to here, data is confirmed, and these are just, and I can say expectations or whatever the data they have got, they have like that. So this is the probable case, and of course, from 238 to 259 is not a big jump, because it is only, I think, 10%. But the disturbing trend is it is rising. Post-COVID, it is still rising. So there is the debt to GDP ratio. Lower this ratio, the better it is, because higher the GDP, better it is. Or you can say lower the GDP and lower the debt, better it is. For Japan, and this for USA, there is a big jump from 107 to 128. This is about 15% jump compared to only 10% in case of Japan. Not only that, there is again a rising trend, not a good sign. Then European Union, there was a declining trend. That is fantastic. And from here, 77.5 to 90, again, about 15% jump, but then it is rising again, of course, at a slow pace. And here comes the China. You cannot, rather I should say, it is very difficult to find out that any significant change in debt to GDP ratio. And now, in 2020, as you can see, from 57.2 to 68, there was a jump of 15%, but overall, on absolute level basis, 76.9 is, I think, the lowest what we have seen in previous slides. And this shows that the Chinese economy is pretty strong, but at the same time, the debt is rising at a very fast pace from last 10 years. And still, post-COVID also, it is rising. Here comes the India. Yes, from 75.33 to 89%. That goes to about 20%. There was a big jump, of course, but at the same time, there is a declining trend since year 2020. This is a very, very positive sign. Yes. So this was all about the debt to GDP. And as you saw that overall, in terms of absolute numbers, China is way ahead and India is the next. Also, in terms of the trend, India is doing fabulously well. Yes. Now coming to the inflation, this is the Japan. Before COVID, Japan inflation was something about average 1%, and now it went up to beyond 4%. Presently, it is about 3.5% or 3.3%. So still way higher than the pre-COVID times. USA, of course, before COVID, the rate of inflation was about 2%, which went up to beyond 8%, up to 9% almost, and now presently it is 6%. And the Japanese Federal Reserve says that our comfort level is here at 2%, long way from now. Then comes the EU. Wow, this is a very disturbing trend. Before 2020, that is before COVID, it was about 1% to 1.5%. But now it has gone beyond 6%, not only gone beyond 6%, but the trend is up. That is very disturbing. Trend is up. Here comes the China. China, it was about 2% before COVID. And just before, at the time of COVID, it went up and beyond 5%, but now presently it is about 1%. That is almost very near to the 10-year low. And as we all know, because of the zero COVID policy, there was a very low level of economic activity, and that is the reason why the Chinese inflation is so low. Nevertheless, in the present circumstances, yes, positive sign when we compare with the rest of the world. Then comes the India, my country, because inflation levels before COVID, it was somewhere here, so 3% or 4%, and now then it went up to almost near to the 8%, as you can see. And then it has come down to about 6% now. Of course, it is high from pre-COVID levels of about 4%, but nevertheless, we are comfortable in terms of that. RBI governor has already said the peak has already gone, and measures are taken to reduce it further. So once again, as you can see, India and China are favorably placed. More so India, because India's economy is expanding at a fast rate, and that is not the case with Chinese. So what is the winning strategy? Let me ask you one thing. The most prominent characteristic which made Warren Buffett to amass a huge wealth. What is the most prominent characteristic? Do you think that it is stock picking, or do you think that it is because of the compounding, or you think that he knows very well what to avoid, and maybe because he has got very good mentors and friends, some of you may be liking this characteristic. This is not a poll, but you can answer in the chat box. So one is avoid. Gentleman says compounding. Let's participate. You write in the chat box. All the four. No, I'm asking for the most prominent characteristic. You have to answer only one. Okay, yes, all the four are important, but which is the most important? Mixture of A, B, C. Again, compounding, then comes the stake. A, C, what to avoid. Okay, compounding. Okay, I'm okay, what to avoid. Compounding, stock picking, compounding. Okay, thank you. Thank you very much. In A, stock picking. Thank you. Thank you very much. So, most of the answers, most of you have responded for compounding, and many of you have responded for what to avoid. And there are people, investors, who think that stock picking is a good quality, and there are very few who say that mentor and friends for the reason is the main characteristic. Of course, every option I have provided has its own place, and of course, he has got very good mentors. Mr. Graham, who is known as the father of value investing, this Mr. Warren Buffett has had an opportunity to study under him. And presently, Mr. Charlie Munger is his partner in Berkshire Hathaway. And also he has changed, Warren Buffett has changed his investment technique from value investing to growth. Also, his father, his dad had a small brokerage house. His father-in-law had a grocery shop. So there are many, many mentors and friends. But the right answer is compounding. Yes, compounding is the right answer. And let me tell you why. Now, this is a poll. Investment of rupees 10 lakh for 82 years at the rate of 15.78% per annum will turn to about why this data matters. Because 10 lakhs investment, I believe that average person can invest 10 lakh rupees. For 82 years, this is very, very difficult. But why this 82 figure? This is 82 because the age of Warren Buffett presently is about 92, 93 years. And he started investing when he was 11. So he has compounded his money for 82 years. Now comes 15.78. Because I am talking about in the Indian context, Sensex has given you 15.78% compound returns for last 44 years. Assuming that these kind of returns will continue for next 82 years, what will happen to your 10 lakhs invested today and 82 years hence? What would be the value? Option A is 95 crores, 9 crores, C is 9,500 crores, and D is 16,500 crores. So I will give you the options. Give you the opportunity to participate. Now this is on your screen. I request all of you to participate. Nothing happens even if you are wrong. This is a learning, and if you are right, then it gives you a confidence. Yes, in both the ways, you are going to be a winner. And from the results, I can see it's going to be a very interesting battle. And I'm very happy to see this kind of results, because as of now, no one has opted for the option B, and all of you are correct. Option B is not the right answer. I request more and more participants to participate. Still, half of the participants have participated. So I have already given you a good hint that B is not the right answer. Okay, 53 participants have given their 57% rather. So with this, we end, and here are the results, as you can see on your screen. So 6% for 95 crores, 39% for 9,500 crores, and 55% for 16,500 crores. I'm very happy to tell you that, yes, this is the right answer. Yes, 16,500 crores. Now just imagine, you need not have to do anything, and you have to do only, the only thing you have to do is invest rupees 10 lakhs in BSE Sensex and forget it. So if the history is anything to go by, after 82 years, you will get 16,500 crores. Many of you might be thinking that, what about the inflation? Yes, inflation Even if you account inflation for 6%, still you will have thousands of crores at your disposal. And without doing anything, you have to sit back. Don't look at what is the NAV. Yes, this is exactly shows the power of compounding. For 82 years, I don't think the average age of an Indian person is not even 82 years. So it is not going to, it is really very, very difficult to stay invested for 82 years. Nevertheless, even if we invest for 30 years or 40 years, we can get a very handsome amount. Yes. Unfortunately, not many are able to create that kind of wealth. So under the winning strategy, first thing is invest for long term without fear. 82 years he is investing. Naturally, there is no fear in him because he is betting on companies. Yes. So this is a very beautiful and lovely picture I'm showing you, and this Disneyland. Yes, I have been to this place, not exactly this place, but I have been to US Disneyland, and this is a very, very lovely place. And the ticket for this is about $100. $100 multiplied by 80, 82, 83, 4. So about 8,500 rupees per person is the ticket, and for full day you can be there and enjoy. So do you think it is a fee or a fine? You are paying a fee or a fine? What $100 you are paying? It is a fee, right? It is not a fine. You are not going to pay a fine. Fine means you should pay and you won't get anything. You made some mistake. When you are going to visit Disneyland, so you are getting an opportunity for that you have to pay 8,000 rupees per ticket. Okay, per person. Similarly, when you are investing in stock market, volatility is a fee, it's not a fine. In fact, volatility gives you an opportunity to buy more, right? But if you are investing for very long term and you don't want to intervene, you don't want to see day in, day out, or maybe for years together, then invest in Sensex. There will be high volatility, but it is not a fine. You have to pay, because without volatility, market will not rise. So we have to pay the fee and sit patiently if you want to see the rosy days ahead for your portfolio. So the second winning strategy is volatility. See volatility as a friend, not as a risk. Yes, because if you are an active investor, then volatility will provide you an opportunity to buy at low prices and sell at high prices. I'm not saying that you have to exit or you have to invest more money. What I mean is you can exit from the overvalued stocks and buy the undervalued stocks. Now, many of you may not be knowing that roughly about 85% of the active mutual funds are not able to outperform their underlying benchmark indices. Yes, 85% in US. This is not Indian data. In India, it is about 65 to 70%. So there are later we are also going to follow the US pattern, because in active mutual funds you have to pay an expense ratio. Also, most of the fund managers are trying to predict the market, which is not possible. That is I'm not saying, this is the data is telling. So you have to be very careful when you are employing an active. So the best thing is invest in 16 diversified stocks. Diversified in terms of the market cap, in terms of the business groups. Just imagine if you had 5-6 stocks in your portfolio, all from the Adani group, what would have happened to your portfolio during the recent time, during the last couple of months? What would have happened? A kind of very high level of volatility. Okay, and all the stocks move same that. because of the same group. So you have to invest in 16 diversified stocks, truly diversified, rather I should say, and all must have attractive stories. That is the future story. And then attractive valuations. Without attractive valuations, you cannot expect your stock to give you the returns, because ultimately stocks follow the earnings. And last one is, I think it is the last one. Remain invested all the time. Don't try to time the month. Yes, remain invested all the time. Don't try to. I get lot of mails, lot of messages on WhatsApp that you should guide investors when to exit and when to enter. We are not into that business. I am really very sorry. I am very poor at predicting the market. Of course, we do keep tab what is happening around the world, what is happening in the Indian economy, what is happening in the US economy, what is happening in the particular sectors where we are invested. But I never ask anybody to sell because the market is going to fall, or to invest because the market is going to rise. What we do is we do the changes in the portfolio depending on case scenarios we are likely to see. Now we are going to begin the question and answer session. Before that, as always, we come with smart word. And today we have got two small smart words for you. Progress happens too slowly to notice. Yes. Setbacks happen too quickly to ignore. That is the reason why when the market falls, we are taken aback. But when the market rises, it rises slowly, right? So, and that is how the compounding works. Compounding works over a period of time. It keeps rising. This is from the book, The Psychology of Money, and written by Morgan Housel. I request all of you to read this book. This is a very good book. And I have got one to show you on my screen. You can see. And it is available on Amazon, all bookstores, online bookstores. And price is 400 rupees. One more smart word. For reasons I have never understood, people like to hear that the world is going to hell. Yeah. If you open the television channels or media, everywhere it will be like that. The American economy is in great trouble. They are going to collapse and all those things. And even for the whole world. But it has never happened that the whole world has collapsed. So be very careful. And one thing is there, whether it is US or Europe or India or China, anywhere, Japan, any country, no country, the government or the central bank would ever like for their corporate collapse. They will do whatever they can do best to stop the collapse. Because it is all the corporate. Everything is corporate. Whole economy is corporate. If there is no corporate, no jobs, no taxes, no banks, nothing is possible. So have confidence. Now we have launched one smart report. It is on 14th of March. This has a target gains of 2.44 times in 3 years and 3 months. That means 39 months. And it is a mid-cap stock. Share price is something about 900 to 1100 rupees. Debt equity ratio is declining very sharp, very fast. It is declining from 1.5 to 0.28 in just little less than 3 years. And those who are interested can visit our website. Under the products, you will find smart report, or you can scan QR code available here. And company has got a huge order book of 3.62 times of the last year revenues. You can imagine 3.62 times of the last year revenues. Not only that, company is in talks with 2 big customers I cannot say customers, but the firms who have their plant in, one of them have a plant in China, and company wants that customer to procure its item in India. More details you can watch on that. So as I said in the beginning, those who are interested to receive such insights, notification for such insights, can send their name and city to our WhatsApp number 9755920780. And this is through, we are going it through a broadcast message. We are giving you the notifications through broadcast message. So only those people who have saved our number, that is this number, they will only get the notifications. Others will not get, because we are sending it through broadcast. Thank you. Now, those who have questions, they can use the reaction available on your screen, or you can use the chat box also to write your queries. Okay, interesting query. Your view on debt mutual funds versus fixed deposit after change in taxation rule. Now, let me tell you, I am very much focused on the stock analysis, because if we are able to generate 25-26% CAGR from last more than 20 years, then naturally we are not interested in debt mutual fund. And that is what I can say, because we are generating so much of returns. Why should I go for debt, or why should I go for any kind of mutual fund? Smart gains, every Wednesday you recommend one stock. Yes, sir. Every Wednesday we recommend one stock, and so in a year you will get 52 advices, and also it is a closed loop. If we have given you a buy advice, definitely you're going to get a sell advice from us. Okay, for emergencies, I think one should go for FD or debt mutual fund, isn't it? Okay, it is like this. When you are making an FD, first thing is you have got an insurance from the government for about, I think, 5 lakhs only, correct? So if you are going for more than 5 lakhs, and if your bank goal is under trouble, then even your FD is not secure. And secondly, if you are investing in FD, what that bank is doing with that money, that bank is doing. Have you ever thought that money is being invested in the companies again? They are investing either in equity or in debt, but they are investing in corporate. And whatever returns they are getting, they are deducting about 3 to 4% of the returns, and the rest is given to you in the form of the interest rate. So why not to invest directly if you have the capability? Since the components of Sensex changes from time to time, is it reliable or fair to compare Sensex of 2 periods? Yes, it is very much makes some meaning, because we are targeting the returns from the Sensex. We don't have to do anything. What are the constituents? We are not bothered about the constituents. We are bothered about the returns. So that is how we are comparing. And then it is a good thing that the BSC authorities, BSC management changes the stocks from time to time. And you will find it interesting that all these 30 companies are the leaders in their respective segments. Most of these companies, rather I should say. So outperforming this index is very, very difficult, very difficult. your views on insurance companies and asset management companies. Of course, in both these sectors, is a coincidence only. You have selected two sectors, and for both these sectors, there are very well managed companies, deep pockets, and large number of companies. In case of insurance as well as in case of asset management companies. When such is the case, then it is the consumer who benefits, not the shareholder. Yes, you go back and look for the other sectors wherein such situation has arrived and who gained the most. It is the consumer, because there is very stiff competition, and all these players have deep pocket. They can spend money like anything. This to give you an example, this happened in telecom about 5-6 years back. You can recall so many players with deep pockets, and ultimately even companies like Tata's have to take a backseat. India is investing in rail infra, seaports, and defense, and how you see the future of these sectors. Yes, they have got excellent future, no doubt. Especially the defense and space, I can say, and we have covered lots of stocks during last 6 months under both smart gains, under this our three schemes: smart gains, multi-bagger, and smart SIP, especially under smart multi-bagger. How to maintain weightage in your smart gain picks? Of course, we will tell you how to give you how to allocate, how to make the weightage. Which companies will get benefited when there is a shift from dollar to rupees? I would like, I'm not very clear what you can rewrite it in some other way. What is your view on ETF? Yes, ETFs are good. If you don't want to hire an advisor, hire the services of an advisor, and you want to do it on your own and you don't have the time, then the index ETFs are the best one. I would recommend you to go for index ETF. During market hours, your recommendation will lead to higher buy price. No, it is both ways. Because one thing, let me make you clear. If I am giving you, suppose I advise you a stock which price is 1,000 rupees. Okay. In 4 years, I am targeting a price of 3,000 rupees. And if normally it doesn't happen, but even if it happens that in 2 years, in 2 years or 3 years, if the market rises and our recommended stock rises from 1,000 to 1,025 rupees or even 1,050 rupees, then how it matters? You just calculate in 4-year period. If your stock moves from 1,000 to 3,000, then what are the returns? If it moves from 1,050 rupees to 3,000, what are the returns? I don't think it would make a substantial difference. Moreover, you can wait. If you think that most of the time we do take care, and we also mentioned specifically that if there is a little less liquidity, then we mention that keep the weightage low or HNI should avoid. Your view on gold, silver, and property. Okay. So overall, when we are investing from a very broader perspective, the gold should be about 10 to 15% of your total investment, and real estate, it depends on your life cycle, because if you are 60 or 70 years of age, then I would not recommend to invest in real estate. It all depends, again, individual to individual. It is just my opinion. And as far as the equity is concerned, as most of you know very well, the thumb rule is 100 minus your age. That much proportion. Effect on upcoming global recession on equity returns in India. I've shown you 100 years of data for US market, and their index has gained at the rate of 10.5% compound for 100 years. And this includes a time of severe recession of 1929. Even with that recession, they have given you 10.5% compound returns. Now, if you in Indian terms, if you want to calculate, then just make the provision, suitable provision for rupee-dollar parity, and you will be astonished to find out how much kind of returns even the S&P US Sensex has delivered. And the same is the case with India. As I said, let it come, whatever it may happen. Ultimately, no country would like to die down their corporate. Never. Even in India, for Yes Bank, you all know what happened. And government has found the solution, even for certain computers, and even for in the recent case of SVB and other banks in US, Credit Suisse. Yes, these things will keep on happening because of the rising debt around the world. Is it advisable to invest some portion of portfolio in foreign equity or mutual fund? Yes, it is advisable. It is advisable. And personally, I have invested about 10% of my total investment in US companies. Previously, India was paying in dollars for crude oil, and now many countries are taking alternate currencies. India, Russia payments are in dollars, and which banks will get benefit of this payment mechanism? Sorry, I am not master in this, and when this equation will change, no one knows. So I don't suggest or invest in such propositions where the outcome is totally in the hands of the government, not the company. Like, for example, I will give you, in case of sugar also, we very rarely recommend any sugar company because the input as well as the output is directly or indirectly controlled by the government. And the same case with fertilizers. Yes, Mr. Jeet, waiting for long.
Thank you very much, sir, for the opportunity. Yes. And excellent webinar as usual. So my doubt, I just want more help from you. Yeah. The data which you have provided in the beginning about Sensex giving for 43 or 44 years returns. It would be really helpful for retail investors like us if you could give the similar kind of data for mid cap and small cap index also.
Okay. Then next time.
Yeah, sure, sir. Thanks, sir.
Yeah.
Thank you.
Thank you. That can be very interesting. That you have given a good idea, and surely we will implement it. And let's have what great insights we can have from the other index also. That would be very helpful in deciding our strategy. Thank you, Jeet. So, any other query? You also advise on foreign equity? No, I don't advise, because in India itself, there are about 1,500 stocks, 1,500 companies, which are worth investigating. Rather, I should say not worth investigating, but those are regularly traded. So there is already a big market which we have to look for. And for US, I think it would be better if we go for their S&P 500 or something, some other index. They have got S&P global index also. That can also be an alternate. So any other query? Shall we end? So thank you very much for sparing your valuable time on Sunday. Have a good day. Thank you.